Today, I'm going to speak about a topic that I am very passionate about: how to help traders reach their full potential as traders and reap the rewards that trading brings, with the top 3 trading habits for 2021 based on the Trader's Pendulum book. This is what the book is all about. It gives you a practical foundation to building your trading business, i.e., building that trading account. Are you spending too much time spinning your wheels without making progress? Not sure which techniques to apply? Want to waste less time analyzing the markets and make more time taking profitable trades? In today's session, let me help you to see a clearer vision for your trading business by sharing with you what I think are the 3 top habits for you to develop in your trading business. And at the end of my presentation, I'm going to share with you a way to stop spinning your wheels and waste less time analyzing the markets so you can take more trades and make sense to the bottom line. If you stay until the end, you will receive a chapter from my book, and you will learn about my one-on-one coaching program. Here's the disclaimer. All traders ride on a pendulum every day. Unsuccessful traders ride the pendulum back and forth with no real idea of the pendulum swing. Picture a pendulum moving back and forth. Successful traders recognize that the pendulum swings and ride it mindfully. As a result, they make better decisions and better trades. The pendulum factors represent 2 situations arising from trading the markets. On one end of the pendulum swing, there is one thing happening, and on the other end, there is another, often opposing thing going on. Ideally, you as a trader want to remain or get back to the neutral position because staying at either end can be unproductive. Let me show you what I mean by discussing the three pendulums listed here. And please note that there is nothing you can do about the swings of a pendulum. It's going to swing, but you need to learn how to ride them. And the lack of skills to weather the swings is what makes trading an emotional, psychological roller coaster ride for traders. Believe me, I've been there. I traded as an institutional trader in the 1980s with JP Morgan, trading the currency markets. That was I had to learn how to deal with a potentially emotional, psychological roller coaster ride. So let's start with the market pendulum. The market trades up and down all the time, but skillful traders know when to enter and exit a trade. They've learned how to recognize the pendulum swings in the market and not to enter trend trades after extreme and exhaustive moves. I'm sure you know what I'm talking about. They readily understand the market cycles and will enter after the corrections or a break of previous market highs. In short, the market pendulums are the trends and the corrections. To trade the market pendulum, you need to have a strategy which you can use to trigger your trades and exit your trades. And I use an Elliott wave-based system to ride the market pendulum. Financial pendulum. Making money from trading is not a one-way street, and especially during these volatile markets. On one end of the pendulum, there are times when you make money, and on the other end are times when you lose money. Both winning and losing money are part and parcel of trading. Every trader loses money, even successful traders. But it's important not to bet the ranch so that if it's a losing trade, you lose the entire account. It's all about managing the money in the account so that you win big. When you lose small. And during the presentation, I'm going to show you a trade management strategy that I use. The emotional pendulum is best described with the fear and greed continuum. On one end of the pendulum swing, you have the desire to earn more money from your trades, and might be driven by greed to take larger positions irresponsibly. But on the other end, you are in fear of losing money, and your actions might be held back by fear. Learning how to balance between these two factors is the focus for you as an investor or trader. Here are some of the emotional pendulum scenarios that traders deal with every day in their trading. And I would say that fear versus greed summarizes the first few emotions below it. For example, self-doubting can lead to fear. Overconfidence can lead to greed. I'm sure you can relate to some of what I'm saying. Being too cautious can come from fear. Reckless trading can come from greed. So I ask you this question. Do you agree that you want to become a trader or investor who can ride the pendulums well? And if you've answered yes, then you will need to become a successful entrepreneurial trader, which is the subject of this presentation. But let's just finish this slide. Organized versus disorganized, flexible versus stubborn, calm versus nervous. These are different things that you might experience while trading. It really is important to be organized versus disorganized. And we'll talk more about that shortly. But first, let me tell you about the technical trader's trap. I'm going to introduce two traders to you, Farah and Fred. Farah, a retired IT professional, decided to take up trading. After 3 years of searching the internet for the next best system, she found herself out $50,000 between money spent on buying systems and losing money trying them. Let's call her frustrated Farah. Fred was a highly paid engineer who was sick of working for an employer. Perhaps it was out of desperation or impulse, or simply because of the life of a trader story that his ex-colleague had told him that attracted Fred to trading. He took the chance and jumped in with both feet. A year after he started in this profession, Fred remained in the seeking mode, endlessly going after every secret strategy that trading gurus guarantee to bring success. He was not earning consistent income, let alone doing as well as he wished. He was at a loss. What he was doing seemed to be both meaningless and unprofitable. So Fred and Farah, who I call the technical junkies, have fallen into the technical trader's trap. They're out of shape with no business plan, no profits, very little discipline. They trade emotionally, and they have not developed a trading plan. In short, they lack a model for their trading business. So are you in the technical trader's trap? Do you want to become an entrepreneurial trader? Let me tell you about Steve and Stacy, our transformed entrepreneurial traders. At the other end of the spectrum, Stacy started her trading career slowly and steadily. It took her months to settle on a system and run tests to prove her strategy, one with which she was finally comfortable. Although selecting and testing her system was a long and painful process, as a result of this legwork, she had been making consistent income. At the same time, the freedom that trading provided had allowed her to be a stay-at-home mom. And if things go well for Stacy, she might decide not to join the full-time workforce at all. At this stage in her trading career, trading seems to offer more flexibility, intellectual stimulation, and reward. What about Steve? Steve begins his trading day by meditating, and his meditation it clears his mind, but it's also a discipline of focus and determination. So this is really important for him. And then 20 minutes later, he's jogging around the park. So by 8 o'clock, Steve is at work in his home office, and he reviews his notes that he made the night before. He starts planning his trading day. Every morning, he has a routine that he follows. He follows this routine. So both Steve and Stacy used to be technical junkies, but they've transformed themselves into successful entrepreneurial traders. They both have a business plan. They make money consistently. They trade with discipline. They trade unemotionally and operate with a clear trading plan. In short, Steve and Stacy are in very good trading shape. So here's how Steve and Stacy became successful. This is the trader's quadrant. Stacy and Steve both moved from the left side of the chart to the right side. What does it take to move from the left side to the right side? Learning the habits of successful traders, which is the subject of this presentation. On the left side is the technical trader's trap. New traders and experienced traders can live there. On the right side is the transformed trader. A new trader can develop good habits and become successful, and an experienced trader can learn from their mistakes and become successful as well. Let me ask you a question. I'd really like all of you to type in the chat box, type the answer. Because we're going to do a little exercise together. How many of you think that trading looks simple? And how many of you think trading is easy? So simple or easy? And I'm sure all of you are thinking, well, Jody, what's the difference between simple and easy? I'm getting some answers. Neither. Okay. I'm going to tell you, making money in trading is simple, but keeping it isn't easy. Making money is about understanding the market, and keeping that money is about understanding you as the trader. You understand the difference, understanding you as a trader. So now let's do it, a little exercise. I'm going to ask you a question. So please write this down in the chat, write the answer while I tell you a little story. And this is the question. If the market were an animal, what animal would it be? If the market were an animal to you, what animal would it be? So take the time to write it down while I tell you a story that Bill Williams used to tell, one of my mentors. Before Albert Einstein died, he wrote to many of his former students and colleagues, and he decided to have a final audience with them in Princeton, New Jersey. He invited about 300 people. These 300 people got together 3 days earlier to decide what questions they would ask Dr. Einstein. The story goes that they argued over the important questions to ask him until on day 3, a scientist from Europe proposed that they ask Einstein which was the most important question that they could ask him. The next morning, with Dr. Einstein on the stage, they asked him this very question, to which he replied, "Is the universe a friendly place?" Before I told you this story, I asked you to name an animal that had the characteristics of the market. So the question is, did you choose a friendly animal or a threatening and dangerous animal? And this is what you've chosen. Many of you chose elephants, tigers, lions, jackrabbit, monkey, Godzilla. So you've chosen these animals. Most of these seem to be pretty threatening and dangerous, don't they? But it's my hope for you that the market becomes a friendly place for you and that you grow as a trader and investor in sync with the markets. Let's start with habit number 5. Understand and exploit your unique trading personality. So this is one of the 3 that we're going to cover today. And thanks for doing that exercise with me, by the way. There are many different trading styles due to the simple fact that everyone is unique. You all have a different trading personality. And different personalities are better suited to certain trading styles. So for example, If you enjoy sitting in front of the screen watching the market action, and some people do it all day long, you might prefer momentum or day trading. If you like to analyze the markets, establish your trade plan and let your trade play itself out and go about your day, you might be better suited to swing trades. You may set 3 different profit levels and hold positions for 1 to 3 days max, and just follow it. As a long-term position trader, you're looking to hold your positions for at least a month, sometimes longer if the market is going your way. For this, you need mental stamina, patience, and the ability to ride out drawdowns because the market doesn't go straight up, as we've already surmised. The market corrects, it moves up, it corrects, it moves up if we're in an uptrend. And there's no right or wrong style. The key is finding the style that suits your temperament and lifestyle. I mean, I know all different kinds of traders. I know traders who really want to just trade in the session for a couple of hours a day and they'll trade momentum and then they're done for the day. And then there are other traders that don't mind taking their positions home at the end of the day, but they prefer to trade in a swing fashion, ready to take their profits when the profits hit their profit targets. Okay, no looking back. And then there are long-term position takers who do their analysis and they decide that this stock or this whatever you're trading is going to go up consistently. It has a great story behind it, and they hold and they look at the market periodically. So it really doesn't matter what kind of trader you are. The key is that you figure out really what's best for you. And one way to look at that is to just ask yourself, well, how do you feel? Can you sleep at night? And a short-term momentum or day trader will look at their positions every day by the way at the end of the day and look to see how they've done in order to improve. A swing trader might look at their weekly trades at the end of the week, so on the weekend, to see how they did. And then a long-term position trader will look at their portfolio and analyze it maybe once a month or maybe even once a quarter. So it really depends on you, but no matter what style you prefer, you can still make the same amount of money. Like it really just that's not the factor here. The factor is how do you feel trading with one of these styles? That's the most important thing. There's no right or wrong style. You just need to find the style that suits your temperament and lifestyle. And lifestyle is key. So this is a matrix to help you determine the trading style that suits you. On the left, we have conventional and manual trading and automated trading. So discretionary trading, there are really 2 types of traders, discretionary and systematic. And they're at opposite ends of the spectrum. A system trader will spend hours each day testing systems on several different markets. He or she might trade 20 different markets using a mechanical system with very little emotion attached to individual trades, but it's really important to test the system and to continue to monitor the system because the market trades in different market cycles, and most trading systems out there work better in trend moves and get chopped up during sideways corrections. So it definitely needs to be monitored. A discretionary trader pores over the charts and then makes her decision and watches the screen in order to pull the trigger for the trade or leaves orders in the market, limit orders. She still has a system, but there is a human component as well. She might not pull the trigger every time or might assign probabilities to the trades and only take ones with higher probabilities. Automated trading can be it can be fully automated or it can be semi-automated. Many traders use semi-automation to get into a trade or semi-automation to exit a trade. It really depends on you. But the institutional traders, they are most of the institutional traders that have automated trading have fully automated trading programs, trading systems with tons of algorithms. Um, you've heard of high frequency trading and black box trading. My only caution to you in terms of the decision to go to be systematic or discretionary depends on your temperament and the objective results of the numbers. So even your discretionary trading can be tested. So whatever path you choose, you must learn as much as possible about your system and grow into an expert in your area. The most important detail is that you develop confidence in yourself, and then once you develop confidence in yourself and your system, you'll be able to follow it. And that brings us to habit number 6, follow a system. If you look at highly successful organizations such as Microsoft, Amazon, or Walmart, you'll find these companies that are doing the same thing, the same way, every day with consistency. They find a winning formula and adhere to it. Ask yourself if you have a winning formula to get that trader's edge. And if so, are you executing that formula or system consistently so that you have confidence in your ability to follow it? In fact, I'm going to ask you a question here. How many of you follow a system? Just type a yes or a no. Do you have a system and do you follow it? That would be a yes. Actually, it's probably 2 questions because some people have systems and then don't follow it. Have you ever been in that camp? Like, it's one thing to develop your own game plan, your own system for your trading style and temperament, but it's another thing to follow it. Do you find that? Yeah, I'm seeing. Mostly so, yes and yes. Right. Busted. Yeah, exactly. I yeah, I know. I believe me. I can relate. No, would like to get that organic but don't know how. Okay. Well, I'm going to give you a way to figure out how at the end of this presentation. Okay? So, the other thing, we spoke about the technical trader's trap. Some of you may have started out by going to lots of seminars, taking loads of courses, reading books, trying everybody's system out there because you just don't know what's right for you. Like, it's really, really difficult when you're like, even at a conference like this where you have a different speaker every hour. How do you know what's right for you? Do you just keep spending money trying everybody out? That's not very practical, is it? It's difficult. It's challenging. I can relate to you totally. So at some point you need to stop jumping from system to system and take a step back to develop your own game, your own game plan, your own system for your own trading style and temperament. And in fact, that's why I decided to offer one-on-one coaching, which I'm going to share at the end of today, because I do have my own strategy and system, but I wear 2 hats. I'm a coach and I'm also a trader, so I teach a methodology. Today, for this session, I'm wearing my coach's hat. Tomorrow at 10 o'clock, I'm going to be done doing another session where I'm going to be wearing my trading hat. But today, as a coach, what I have found is that there's so many people starting out, or even people who have been trading for a while, they're just, especially with the pandemic, they're getting bombarded with things and they just don't know which way to turn. And everything is moving so fast. The markets, are moving fast. Everything is just moving fast. So that's why I'm going to be offering a one-on-one coaching with me to figure this out for anybody that really wants to get a plan and figure out how they can be trading based on their trading personality. So follow a system, develop confidence in yourself to follow your system. So on this, let's talk about like the specific chart setup, general rules, and entries and exits, which are all key components to your trading system. The specific chart setup is about like the markets that you're going to be trading, the time zones and the time frames. So many traders say to me, well, I get so confused. I don't know what time frames to look at. Do I look at the 15-minute chart? Do I look at the daily chart? What do I do? And the important thing is to be consistent, and it all goes back to what kind of trader are you. So a short-term momentum trader will be looking at the smaller time frames. The long-term position taker will be looking at the bigger time frames. But even as a short-term trader or a medium-term trader, swing trader, you need to have the bigger perspective on the market. Like, you need to know what the big picture is. So for chart setup, some of you will dress up your charts with indicators. Some of you will just look at the price action and the candlestick patterns to help you determine if we're in a trend or in a sideways market. It's really up to you how you dress up your chart, or if you have a naked chart. General rules. This is a set of rules that hold true all the time. One of the rules might remind you to stick to the plan. Another rule might say, wait for the market to pull back before jumping in, like if it's an exhaustive move, for example. Another rule might say, read my rules every day. So these are a set of general rules that you'd write down, and I would suggest reading them every day just to keep you in the zone, just to keep you following your plan. Specific entries and exits. What triggers the buy and sell decisions? Okay, that's important. That's part of your strategy. When do you get in? And then what are your exits? Exits include stop losses and targets. If the market moves against you, are you going to stay in your trade? You might, as long as it doesn't break below a key level. But if it breaks below a key level and then you decide to stay in and it goes further, well, that's how the big losses occur. And that's what we want to keep to a minimum. We want to get out of the bad trades and keep our winning trades, stay in the winning trades. Because we don't have a crystal ball. We don't, something is not going to go up forever. So this is part of your trading system. Now let's just take a little pause here before we get to habit number 7, and let's talk about the market cycles. This is my expertise. This is what I do day in and day out. And look at the red line here. The red line is your longer term chart, let's say. Let's say it's your daily or your weekly. Let's say it's a daily. The green dotted, let's say it's a 4-hour chart. And the blue, or that, not a 4-hour, let's say it's an hourly. And the blue, let's say it's a 4-hour. Notice how where I have the blue arrows for the buys, that's when the 4-hour does a retracement. But the daily trend is still up. So when the 4-hour does a retracement, that's the time to buy. You don't want to buy when the market has moved up in a 5-wave sequence. Let's say over here, you want to wait for the market to come back to neutrality. You want to wait for the market to come back to the moving averages. And the hourly green dotted line will come down also back to that same level. And that's where you want to buy. You want to buy on the dips. Okay? In an uptrend, you want to buy on the dips. So let's just read what I have written to the right. An uptrend, the definition is higher highs and higher lows. That's how you know if you're in an uptrend. Also, uptrends are usually within channel lines. Okay, so you can literally draw channels around the uptrend to know that we're still in the uptrend channel. And then when we break down, that means that we're perhaps in a larger corrective move down. And you might want to get out once we break down through the channel. That would be one of your exit criteria. If the long-term trend is up, the medium-term and short-term trends will cycle through trends and corrections, giving multiple buy signals along the way. So these are the buy signals. I like to buy stocks that are in a healthy uptrend. That's what I like to do. I don't like to buy stocks, for example, that are in a downtrend. That's not what I do. Like, we have a whole universe of stocks to buy. If you trade currencies, same thing. You want to be buying in an uptrend. You don't necessarily want to be buying in a downtrend unless, like I said, unless the downtrend is in the shorter time frame, let's say the 15-minute or the hourly, and the longer time frame is bullish, then you'd want to buy on the dip on that time frame. So trending versus sideways markets. It's important to know the difference. I would consider this a sideways correction, and corrections can be steep corrections, and they can also be sort of sideways, flat corrections, just moving sideways. Just the market needs time for price to adjust, for price to come back to the moving averages, for example. Now here I have a series of moving averages on the chart, and this hourly chart highlights the moving averages that capture the broad trends in the market. When the moving averages are pointed up and separating, the uptrend is in full force and the trader can buy the dips. When the moving averages are twisted and sideways, such as this piece here within the box, the market is in a sideways consolidation phase, and it is best to wait for the trend continuation before buying in an uptrend or selling in a downtrend. So we have a long period of sideways consolidation here where price trades above and below the moving averages. And then we break above. You can literally draw a box around it. And when we break above, that's the time that you can get in. And this wastes less time. The only problem is you really need to monitor the sideways price action and leave trade alerts for when we break out of the sideways consolidation. That's one way to do it. Leave an alert in your trading platform. When the moving averages are separating and pointed up, this is the time to get in. And then the market corrects again, and the averages come back together again, and then they separate again. So I just want you to get a sense of sideways versus trend continuation patterns in the market. And even though this is an hourly chart, just know that the markets are fractal. And what that means is that the markets patterns are the same, whether you're looking at a 1-minute chart, a 5-minute chart, a 15-minute chart, an hourly chart, a 4-hour chart, a daily chart, a weekly chart. The patterns that you're going to see are exactly the same, only on different time frames. I think moving averages are a really good way to see if the market is in a trend or not. When the price is above the averages, that's an uptrend. When price is in the averages and the averages are flip-flopping back and forth, that's a sideways market. So just understand the personality of the markets. Not only do you have a trading personality, but the markets have personalities as well. So a strong trend is one personality. A sideways market is another personality. let's talk about the difference between a trading system, a trading strategy, and a trade plan. A trading system is the big picture. That's a collection of trading strategies. That's what it is. So the trading strategy, you might have a trend trading strategy, you might have a sideways trading strategy, you might have an end of trend trading strategy, and these all make up your trading system. So moving down to the trading strategy, entries and exits based on price action, analysis techniques, and or chart setup with indicators. Your trading strategy actually tells you when to get into a position, when to get in, when to get out. The trade plan is a set of rules for when a trade opportunity arises. So once you have your trading strategy and you say, okay, this is a good setup to go long, then your trade plan is going to define what your trigger price is, what your stop loss is, and what your profit targets are. And you don't have to set profit targets. You can trail your stop. You can decide to take profits any way you want, but the key is to make sure you have a plan for taking your profits, because the markets don't they don't move up continuously. They do correct. So you might want to take partial profits when the market moves up to a certain level, and then that would give you the flexibility to buy again on a dip, for example. The path to greatness lies not only in our performance, but in the systematic practice we put into it. Trading mastery is a function of internalizing market patterns, rehearsing execution skills for trade entries and exits, learning from the constant market feedback mechanism. And without a trade plan, our emotions get in the way. Traders run the gamut on the fear and greed continuum. So planning the trade and trading the plan is the practice we need to develop solid habits as a successful trader. Just in reviewing my trades, I find that the more profitable ones are the ones in which I knew what I was pursuing. Like I have a goal. I plan out my trade. And even when they don't work out, the losses are held to a minimum because I have a plan and I quickly realize that what I was looking for isn't there, and I exit to preserve my capital. Do I always do this? No, absolutely not. But when I do this, that's when I feel better about myself. I feel better about my trading. My trading results are much better as well. On the flip side, all trades in which losses are far greater than they could be or should have been have one thing in common. They all have the element of confusion and not knowing exactly what I was looking for in the trade. I mean, I could easily take a trade and not plan it out and then I'm just hypothetically watch the market move against me and still not have a plan, because I just impulsively took the position. So, bottom line is, when you don't know what you're doing, you don't have a plan, it's easy to let small losses turn into larger ones and then sell at the bottom or buy at the top just to get rid of the pain. Can anyone relate? Okay. I see some yeses. Okay, great. Absolutely. Yeah. And yeah, so moving right along, the trading blotter. This is a manual trading blotter to plan the trade and trade the plan. And I'm going to show you on the next slide what a good trading blotter is. It has the analysis piece, the checklist, which is your trading strategy, And then you can look for high probability trades and prepare your trade plan and then do a post-market review. And this is what it looks like. You can take a screenshot and develop your own. Okay? So on the top, the top row is all about the analysis. And you can do whatever analysis you want to do. I've already told you that I use Elliott wave analysis and I use Fibonacci's. It's also important to do some cross markets analysis to understand um, what's going on in the global markets, what's happening in U.S. equities and European and Asian equities, what are interest rates doing, what is happening with oil, with gold, what's happening with cryptocurrencies. I mean, this can certainly be updated for for today's markets. You can have if you're trading stocks, you can have the different market sectors there. You can say what's happening with the technology stocks, what's happening with large market cap, mid-size, small cap markets. It's really up to you. It depends on what you trade. If you're trading the currencies, then you want to know what's happening with some of the yen crosses. You want to know what's happening with the euro pairs. You want to know what's happening with the pound and the pound pairs. So there's a lot to you want to know what's happening with the risk on currencies, with the risk off currencies. I'm just throwing some ideas out there. And then the middle is your checklist. Write down your trading rules. And when you're looking and analyzing a chart, see if you have a trade set up. And if you have a trade set up based on your strategy, then on the right is where your trade plan comes in. You pull the trigger. And then what's your entry strategy? And then what is your exit strategy? Where is your stop loss? Where are your profit targets? Then at the bottom we have, I'm going to change post-trade analysis. Let's call it post-trade analysis. Make note about your feelings before trading, and then your actual trade planning, and then your actual trade results. Like do a little bit of work to see where your emotions fit into your trading. Okay, because I'm telling you, it's really what happens in your personal life shows up in your trading. It just does. It just does. Which is why, as an institutional trader, if anybody experiences a major loss, like most of they're usually told to take the week off, because there's no point in trading when you experience a major loss. You should be, you're going to be thinking about that while you're trading. So take time off. So that's the trading plotter. Okay, and again, you just figure out what you want to do for yourself. If this seems too long for you, yeah, you don't need, just do a little bit of analysis, look at your trading strategy, set up your trade plan, and then at the end of the day or at the end of the week or at the end of the month, do your post-trade analysis. That's it, simple. So now let me show you a trade management strategy that I use. Okay, it's called, this in general, there are 4 trade management strategies. One is that you get in and out all at once. The second is that you get in all at once and take profits at various levels. The third is getting into the position at various levels and getting out all at once, and then getting in and out at various levels. So I'm going to talk to you about strategy number two, getting in all at once and taking profits at various levels. And it's called the Three Profiteers. And I developed this for me because as a perfectionist, I wanted to capture every last drop of the move. And this was a good way for me not to take profits along the way. And it's also good for maintaining balance on the fear and greed continuum. So this is what you do. Now this is using it, a Forex example because I talk about pips, but it can be stocks as well. just instead of pips, think of it as dollars. Okay, so determine the potential profit area, the PPA. Assume the PPA is 100 pips, or let's say it's $10, or let's say it's $100. And stocks doesn't really matter. Then use the Fibonacci sequence, and this is the Fibonacci sequence, and pick 3 profit targets, the third ending at your PPA. So if this is pips, this would be pips. If it were let's say if your PPA is $10, then the 8 would be 80 cents. This would be $1.30. This would be $2.10, $3.40, $5.50, $8.90. Okay. You work backwards from the 100 pip PPA with the Fibonacci sequence to determine your profit objectives. So that would be 89, 55, and 34, or $8.90, $5.50, $3.40. And these are your 3 profit targets. You set your stop loss at the first profit target, which is 34 pips, and then move your stop to break even once your first profit target is hit. Then move your stop to P1 once P2 is met. Now you can modify this a little bit, but in terms of your stop losses, but this is just this is an example of how you can use it in a simple way. If you get all 3 profit targets, this is your risk reward, 1.74. So you're making 1.74 profits to your risk, times your risk. Here's an example. This is the euro. It's a 4-hour, just an example to illustrate it. We're looking for a move up into this area where the green line is. That's a 55 pip difference. And so using the 3 profiteers and working backwards, the 3 profit targets are 55, 34, and 21 pips. We work from the 121.75 entry price, and we calculate the targets, first, second, and third targets. And we can put these targets right in our trading platform. Okay. And then this is our stop loss. And in this example, 2 out of the 3 profit targets were hit, and the third profit target exited in a profit. So there was no loss on any 3 of these positions. Okay? So that's the 3 profiteers. If you're trading and you're wondering, how can I take profits without feeling bad if the market continues to move higher, then pick 2 or 3 profit levels so that you can take profits along the way in case it corrects and moves against you, and you could actually, add to your position again. But if the market goes up and you don't take any profits, and then it comes all the way back down to where you first entered the position, your emotions are going to kick in. You're not going to be a happy camper, right? So that's why I developed the 3 profiteers, to be able to take profits along the way for me, so I would feel good when the market is moving in my direction and I can take some profits. We just learned 3 of the 10 habits of successful traders, and learning them will help you save time and effort, make more money, and achieve your full potential as a trader. Now, I'm going for stock options, Forex, and futures traders. Let me invite you to join my FXTE Next Level Coaching Program so you can have your own personalized trading plan that you can follow with confidence. Jeff said this, Jody, one of my coaching clients. Jody Samuels has been my coach for over 1.5 years. Working with her has truly been rewarding. She has a vast knowledge of the markets and combines that with extraordinary technical expertise, patience, creativity, and discipline. My investing skills have definitely been enhanced by this experience, and she is spot on with her assessment of the 10 habits to becoming a successful trader. Success takes work, but the outcome is well worth the journey. let me present to you my next level coaching program. And this is where it is, where you sign up, fxtradersedge.com/next-level-coaching. David posted it in the box. Work with me to create a blueprint for your trading business. The FXTE Next Level Coaching Program includes first, assessing your current strengths and weaknesses, assess your current situation and clarify your goals, develop a step-by-step action plan to achieve your goals, outline the strategies, tools, and timelines to achieve your goals, discuss your capabilities to help you implement your goals blueprint. This is what we're going to do together, and this is how we're going to do it. We will start out with a 45-minute starter session where I ask you a bunch of questions and we talk about, I get a really good sense of you as a trader. Okay. Then we will work on the blueprint and we will complete this blueprint in a personalized 3-hour session, which can be broken up into 1 or 2 sessions. Then you will have a plan to follow, and I expect you to follow it. And then we will have a 1-month follow-up to check in on you. And you will have access to me really with, by emails, unlimited emails. And you will receive a planning blueprint for your trading business. So I really, why am I doing this? You might ask, why am I really spending, spending a lot of my own personal time? I think it's really the pandemic has made me realize that there's just so much going on and that this is just a needed niche in the market. And also, it gives me an opportunity to speak one-on-one to traders, which I really miss. I miss it. So I want to be more engaged with traders. I have something to offer, and I've helped a lot of people, and I guess this is what I'm going to be doing now. But I'm only going to be taking 10 people for this because my time is limited. And that's it. Just the first 10 people I'll take because it's my personal time. Here's another testimonial. Bob and I have been trading partners since 2015. We both read Jody's book. We had a very detailed planning session with Jody, which pinpointed areas which we hadn't even thought of yet. We both found her to be very intelligent, knowledgeable, and willing to understand our system and help us to make it more profitable. Her approach is a holistic approach which encompasses both technical trading ideas and how to make trading fit into our overall life. Bob and Kim. The price is $497 for your private one-on-one sessions. And what is the case for a coach? Manchester Inc. surveyed 100 executives, most of which were from Fortune 1000 companies. The research showed that a company's investment in executive coaching realized an average ROI of almost 6 times the cost of the coaching. Here's another one. According to the International Coaching Federation, ICF, 86% of organizations saw an ROI on their coaching engagements, and 96% of those who had an executive coach said they would repeat the process again. Behind these results were tangible as well as intangible factors. Tangible factors were areas such as increased productivity, higher levels of overall employee performance, and higher engagement. Intangible factors were increased confidence of those being coached. And I would say that probably increased confidence as an intangible is really, really, really important. In speaking to traders, I'm told just so often that, gee, I'm not confident with my trading system. I don't follow my trading system. I don't have confidence in it. As a trader, I don't know when I should enter. I don't know where I should exit. I mean, these are all things that we would be discussing, and we would put a plan in place. And the day came when the risk it took to remain tight inside the bud was more painful than the risk it took to blossom. It is my hope for you that you blossom as traders, as investors. We are in unprecedented times right now with the markets, and it's really my hope for you that you blossom as traders. Vladimir is saying, as a very experienced trader, I highly recommend this coaching, which is not offered much in this business, except at very premium prices. Thank you, Vladimir. So again, I'm only going to take 10 students, and that's it. So this is your opportunity to work with me one-on-one. So I promised you a gift. Downloading the Becoming an Entrepreneurial Trader, the process, chapter 3 of my book. So you can just jot this down, wavytunnelpro.com/chapter 3, and you can download this chapter of the book. If you have any questions, please email me, Jody at fxtradersedge.com. I look forward to working with you one-on-one. I'm excited about this venture, and I'm excited about wearing my coaching hat because I want to see you succeed. So thank you very much, and thank you, David, and my time is up.